elements, you're obviously going to just make sure you're always looking for directionality and ranges. These implied volatility ranges are very, very important. But also important is the fact that you've got this type of a big build here. Look at the size of that build there, guys. I know it's the big monthlies, but you can see that there is a very, very large number here of 390. So obviously when you're looking at that, you can say, well, we've got 18 days to expiry. The big question is, when does that massive, massive 390 actually get hedged out? And of course, you might also be then saying, but when do we hedge out any of these other ones? When do we hedge out the 400s? When do we hedge out the 420s? In other words, what's the downside potential for that 390 to run into the end of hedge trade? Because you don't keep hedging forever. A lot of people think as soon as you're hedging sell side, it keeps going sell side. It doesn't. At some stage you've got 100% hedge. It doesn't have any more impact the more it drops. You don't lose any more money. It's hedged. It's finished. And this is why we were talking about the Black-Scholes model earlier on today, so that we can establish what that number is in terms of all these products.